Hi, folks. This is Daniela Cambone, and welcome back to Stansberry Investor. We have a great episode for you today. But before we get to it, I just want to share with you a report that we have just put out that I highly recommend you check out. With most investors going about life, investing, and retirement planning as if nothing unusual has happened to our financial system, not realizing the repercussions of the 11 trillion that's been pumped into the U.S. financial system in the past 18 months alone, it's especially a good read at this moment in time. At least 4 billionaires have stated publicly that Americans aren't paying enough attention to this development. And now a former Goldman Sachs banker says sooner than most people think, millions of Americans will potentially be pushed down out of the middle class, out of private retirement, and out of a decent life based on independence and privacy into a collectivist nightmare he calls financial lockdown. So find out how to protect yourself, your money, and your family with a free copy of his new report. In it, he'll show you the 4 steps he recommends that you take immediately. So if you'd like a free copy of the report, you simply have to go to wakeupcall2021.com. All right, let's get to today's episode with my very special guest, Rick Rule, formerly of Sprott, now the founder of Rule Investment Media. We are talking inflation and what could an inflation fallout do and mean for the markets. Rick, always good to have you on. Welcome back to Stansberry Investor.
Daniela, it's delightful to be back with you virtually, unfortunately, rather than in person, but we'll take what we can get in these days.
Absolutely. And I'm sure that day is coming. Well, we will be reunited, Rick. But in the meantime, I couldn't wait to get you on because, as you know, there's so much drama surrounding Jerome Powell and the Fed. I need you to help us make sense of what's going on, because to me right now, it almost seems like the tale of two Feds. It reminds me of those books we read as kids that, had choose between the endings. Turn to page 29 if you want to meet the dragon, or page 30 if you want to go down the gold road. My question to you is, with the talk of inflation and now Jerome Powell saying, okay, perhaps it's not as transitory, is the market prepared?
Daniela, that's a great question. And I'm delighted that as a journalist, you use the word drama because there's a couple things to consider. One, the sort of drama around it, the story. The second, and more serious, I think, is the reality. And I'd like to begin, Daniela, with my normal disclaimer. I'm not an economist. I'm an investor, I'm a speculator, I'm a lender, but I'm not an economist. It would appear to me that people have been inured living through 40 years of very benign economic conditions, not to expect inflation. We've seen a circumstance where inflation and where the interest rate has fallen for 40 years. We have come to believe in the Fed put. We have come to believe that Mr. Powell and his predecessors were more important to our financial well-being than our own efforts and our propensity to spend. And I think the consequence of that is that people have ignored the arithmetic of basic inflation. People have ignored the warning signs because they haven't experienced inflation for 40 years. Just as in the 80s, when inflation was on the decline, people's expectations were formed in the 70s. And so people were afraid of inflation for 10 years after one would suggest that the inflation dragon had been slayed. The circumstance that we have now, I think, is that people have come not to expect inflation. And so even though the warning signs are in place, hell, the warning signs, the arithmetic, even though the arithmetic and the evidence around inflation are in place, people have been conditioned by 40 years not to expect it, and it will certainly surprise them.
Well, I just want to share with you a quote from Jeremy Siegel of Wharton, who is generally positive when it comes to market forecasts. He's now warning of a painful quarter for Wall Street. He says, we're headed for some trouble ahead. Inflation in general is going to be a much bigger problem than the Fed believes.
Maybe a bigger problem that he suggests, given that he's worried about a quarter. I'm worried about 5 years and 10 years. I think we've become inured, among other things, to the drama, which is what causes us to think about quarters. If you think about the arithmetic around inflation, Daniela, think about it from the perspective of the saver. The US 10-year Treasury generates 125 basis points, which means the government pays you 1.25% a year to borrow your money for 10 years. The government's own statistics suggest that the purchasing power of the currency that they're paying you back in is declining by 5.5%. So over the course of 10 years, you experience 4%, well, 4.25% negative yield, which is to say at the end of 10 years, over 60% of your purchasing power is destroyed. I'm not worried about the quarter. I mean, for myself, I'm not worried about anything. For the length and breadth of American wage earners and savers, and for the strength of the US economy, I'm plenty worried because the arithmetic around inflation, particularly for savers, is really, truly ugly.
So what should the Fed do here? You know, we talk about taper or not to taper. Is there a third solution we're missing here?
I think as the economy is currently configured that there isn't. You'll recall a year ago, you and I visited on this topic, and we talked about the fact that the Fed is between a rock and a hard place. They have been the market and the economy's instrument of last resort. In other words, we have decided as a people that we're not going to have hard times anymore. And the consequence of that is that whenever hard times appear, we solve them by counterfeiting. The way that you get out of this circumstance is to spend less, which isn't politically tenable, allow interest rates to be set by the market, which is to say that you don't subsidize idiotic activities with low interest rates, and you dismantle some aspects of an unfunded service mechanism. At the federal level, there's $150 trillion in on-balance sheet and off-balance sheet liabilities. Something like 120 trillion of it is in trust funds and entitlements. And you need to deal with that at some point in time. But I don't think there's the political will in place. So when I say the Fed is between a rock and a hard spot, the very low interest rates that they've promulgated is one of the things that has put them in the place they are now, and is one of the drivers of inflation. But it would be very difficult for the economy to stand higher interest rates. Let me give your viewers one example of that. Traditionally, the yield on the US 10-year Treasury has been positive. That is to say, there has been a positive yield, a real yield on top of inflation. If, as the federal government suggests, the current rate of depreciation of the dollar is 5.5%, that would suggest in a free market that the interest yield on the US 10-year Treasury would be at least 6.5%, which means that the interest charge that federal, state, and local governments, never mind consumers, would pay would quadruple. That would do an interesting thing to the deficit, wouldn't it? Perhaps more concerning to your audience, traditionally over 4 years, the yield on the 30-year fixed mortgage rate has traded at a premium coupon to the US 10-year. So imagine what would happen if the 30-year fixed mortgage rate went from 3.25 to some number like 7.5. Housing would certainly become more affordable, but I don't think that the economy would like it.
And we'll talk about real estate in a second. But I love how you said that, Rick. That there's so much truth in that statement, that we don't want to accept hard times, and we'll do anything to avoid it. Do you think that the Fed knows that they're in a rock and a hard place, as you say? Are they more concerned than they're letting on?
I think they must be. While I don't like what it is that the Fed does or how they do it, I believe that those are very smart people who understand the workings of the economy, and they understand the realities of politics. I think they absolutely positively know that they're between a rock and a hard spot. And they hope or pray, perhaps if they're religious, that they can work their way out of it. Stalling has been a wonderful technique for 10 years. Kicking the can down the road has been a wonderful technique for 10 years. At some point in time, you run out of patience in the market. At some point in time, Wall Street decides that they aren't going to play chicken with counterfeiting and artificially low interest rates anymore, and they're going to go to the mattresses.
Okay. So I want to bring up sectors now, right? talked about gold. So here's my question to you now. In the 1970 style inflation, we saw the rush to gold, how people were turning to precious metals. Why are we not seeing that yet today? Is it because people haven't bought the inflation story yet, or are people looking to Bitcoin today rather than gold?
I was going to ask you that, Daniela. You're a journalist. I'm just a loan shark. I have three possible explanations. I think that the biggest competition that gold faces is the S&P 500. People, including Warren Buffett, believe that the finest corporations, the finest private businesses in the world have sufficient pricing power, that they themselves are good inflation hedges. Buffett perhaps proved that in the decade of the 1970s. I would tell some of your listeners, don't try this at home. He's a pretty smart guy. But I think that the biggest competition that gold faces among retail investors is the S&P 500, or for the more speculative elements of your audience, the triple Q, the technology stocks. For family offices, when I pose this question to them, which I do frequently, most family offices have been taught over the last 40 years that the way you defeat inflation is to buy fairly high quality real estate with long-term fixed mortgages. The idea being that inflation raises the cost of new construction. Taxes and fees on real estate only go up, and you can raise rents a little bit, but your cost of capital stays firm. So if you have a 30-year fixed rate at 3 and change, which stays intact for 30 years, and your rents increase at 3 or 4% per annum, the delta between the return on capital and the cost of capital helps you keep pace with inflation. The only pushback that I can give you there is, and this game has been very good to me, by the way, the only pushback that I can give you is if interest rates rise, the cap rates that you pay for this real estate or you receive when you sell it fall. And relying solely on an increased delta in the face of the fact that cap rates probably can't fall anymore becomes dangerous. With regards to the cryptos, I think this really is drama. The market cap of precious metals relative to other asset classes worldwide is infinitesimal. And the market capitalization of crypto relative to other assets is even more infinitesimal. I think maybe they compete with each other on the speculative fringes, on the margins. In other words, a $10,000 gold buyer may be disintermediated to crypto. But for things like sovereign wealth funds, university endowments, ultra high net worth families, there is no quarrel. They are both such small asset classes as to be irrelevant. Your audience and my audience, who are more speculative and care about such things, are determinedly concerned about the relative market share of gold and cryptos, but neither of them matter in the global scheme.
Well, interesting you say that. Can we explore that a little further? Because there is the school of thought, and I've spoken to people who firmly believe this, that Bitcoin has to chip away at a market cap. It has chosen gold almost as that low-hanging fruit of, hey, this is an easy one to pick on. It needs to take away some of that market cap from gold to be sustainable.
I don't think that the economy or investors care much about what the crypto community thinks they have to do. I don't have the appropriate numbers for crypto, but let's look at precious metals market share. In the United States, precious metals and precious metals related investments comprise about 0.5% of total savings and investment assets in the country. That's down from a 3-decade mean of 1.5% to 2%. And crypto's even smaller than that. We flatter ourselves in these business by thinking that we're an afterthought. My discussion with regards to gold is that gold doesn't have to win the war against crypto, which on a global scale is an irrelevancy. And it doesn't have to even win the war against the US dollar. It has to lose the war less badly. If ownership of precious metals and precious metals related assets in the US market returned to its 3-decade mean, demand would triple. There is lots of room for precious metals and lots of room for cryptos. I personally believe that they serve very different functions. They are competing right now for a market that's highly visible, that you and I both deal with and are part of. But the competition between them is irrelevant on even a national scale, but much less an international scale.
Really well said, Rick. But just another point I want to bring up, you mentioned the tech sector before, technology stocks, and there is also an opinion that should we see a taper and markets get hit hard or implode or whatever people are saying, that tech stocks, long duration stocks would get hit hardest. Do you agree? Are there sectors that you're looking to avoid completely right now?
I avoid tech not because of valuations, but rather because in my declining years, I tend to invest in industries that I can understand. And for the most part, the technologically based businesses are businesses where I don't believe that I have a durable competitive advantage over other investors. When I look at the margins that are generated by the mature technology businesses, I'm attracted to them. I'm just not smart enough to know whether those advantages are durable. So I stay out of the tech sector, not because of its sector advantages or disadvantages, but rather my own disadvantage compared to other speculators who might be more competent in understanding technology than I. I have a rule in place now, Daniela. I won't invest in an industry that I can't understand, and certainly won't invest in an industry where I can't either spell it or pronounce it.
Amen to that. Amen to that. I completely agree with that, Rick. Let's talk about miners, which is something we both right. know and feel very comfortable with and love talking about. Silver miner ETFs just had their worst quarterly outflows ever. Let's talk about deep value opportunities here and seeing the glass half full or empty.
As you've known me for a long time, Daniela. I'm smiling. The truth is, I have enough money now that Bonnie and I can get through life without breaking a sweat. But that notwithstanding, for some odd reason, I want more. And I believe that the wind is really, truly, firmly in precious metal sales, meaning that I would like to own not merely more, but lots more. And the idea that a sector that I'd like to own lots more of is going down in price, to me, is absolutely wonderful. Imagine yourself, Daniela, in suburban New York City, and winter's coming. So you decide that you want to get yourself a nice coat. Your old coat's from Montreal and it's outlived its purposes. And you go into a shopping mall and you're expecting to pay $300 for a coat. And you see that coat marked down to $160 from $300. You want the coat. Are you happy or are you sad? The idea that people don't buy mining stocks the way they buy coats is absolutely mystifying to me and absolutely delightful.
And physical metal to that point as well, right? It's all about
absolutely
perspective.
Absolutely. If you have the courage of your convictions, which I understand that many speculators don't, the idea that your perceptions differ from the markets is a gift from God.
So would you not be touching real estate now?
I'm very nervous about the fact that real estate prices are propelled by artificially low interest rates. When I bought real estate precisely because of the delta we talked about earlier in this interview. My cost of capital stayed the same while I could increase my rents. And the delta between my return on capital employed and my cost of capital rose. It didn't occur to me in 1990 that the cap rate, the discount rate would change. In other words, I got this huge benefit for free, which will tell you how little I knew about real estate. I don't see interest rates going sub-zero in a real sense, which means that the discount rate or the cap rate that contributed so much to the performance of my own real estate portfolio is no longer wind in my sails. If you are competent in real estate, if you can buy a piece of property and you have the skill set relative to your competitors to upgrade it, in other words, if you are competent in the business, real estate is one of the great businesses known to man. I'm just not particularly competitive in it. The only sector where I am increasing my personal exposure to real estate is very high quality farmland in the upper Midwest of the United States. I believe that water has been an undervalued component of farmland investing for 50 years. And I believe that that neglect is coming to a halt. So to the extent that I can buy very high quality farmland in the US upper Midwest, I'm doing that fairly aggressively.
And how does one go about doing that, Rick? Because I have a lot of experts coming on saying I'm buying farmland, but how does that really work? I mean, are you looking at the farm? Are you going there? How does one buy farmland?
That's a very long discussion, Daniela. I can tell you that at age 68, the idea that I am going to be driving a tractor or, heaven forbid, stretching a fence is over. I'm not even going to negotiate leases between myself and a tenant. I buy farmland with very, very high quality farm managers, a couple of whom I've known now for a decade. I don't any longer want to be involved in operating farmland. There's an interesting dynamic where the farmers my age, well, some of them are dying, the rest of them are retiring. And it's a very capital intensive business. And often, their children want to become Daniela Cambones. They don't want to be stretching fences anymore. So what's happening is that there's an emergence of a class of super farmers, family farms that operate 4,000 or 5,000 acres. They may own 600 of them and lease the rest. And so agricultural real estate has become an asset class like other real estate. We buy very high quality farmland in the upper Midwest, and we lease it on a net lease basis, the same as we might a warehouse, to a family of super farmers, somebody who farms 5,000 or 6,000 acres. Great for them, great for us.
Okay, I appreciate those insights. Rick, any final thoughts for investors watching as the tale of the Fed unfolds, all the drama in Congress? There's so much happening these days. How does an investor stay focused?
I think the investor must first focus, particularly younger investors, on their own education. If you rely particularly on the popular media, I think you're setting yourself up for real failure. Understand that their job is to sell you bread or sell you soap or sell you mutual funds. And the consequence of that is that any theme they talk about has to be so broadly acceptable and popular that its time has passed. You need to educate yourself so that your perceptions are formed by yourself with your own family in mind, not by the greater fools. Buffett famously says that the market in the near term is a voting machine. In the long term, it's a weighing machine. If you are happy with the way Americans vote, perhaps you're happy with the outcome that you can expect by playing the latest fad promoted by Wall Street. I'm not. I believe myself, as we've said earlier, that the wind is in the sails of precious metals in particular, which attracts me because I know something about them and I'd like to buy more of them. As we discussed, you and I, 9 months ago, the energy sector, despite the fact that maybe Biden doesn't like it and Merkel didn't like it, the big thinkers don't like it, everybody else does. Everybody else wants to drive cars and stay warm. And so the oil and gas business, contrary to other people's demise, didn't go away. And it still looks very, very, very attractively priced. The final thing I'll say, Daniela, and I've noticed a lot of people making this mistake, it is true that your cash savings are costing you money. It is true that when you put money in the bank and you make 50 basis points, in a world where the purchasing power of those savings are costing you 550 basis points, you have to hold cash anyway. Because a circumstance, and I'm not saying it's going to happen, a circumstance where you have a dramatic reckoning, something like 2008 or 1987 or 1990, liquidity squeezes, when they occur in the market, take down the price of everything temporarily, the good, the bad, and the ugly. Having the cash gives you the tools and the courage to take advantage of that circumstance rather than being taken advantage of. I look at the depreciation of the purchasing power of my savings as being an options premium, to have the liquidity to take advantage of illiquid times in the market. One final thing, if I might, Daniela, I always like talking to your audience about natural resource stocks. And as always, I would offer any of your listeners who care what I think about their specific portfolio rather than their investment philosophy to go to a website, ruleinvestmentmedia.com. Enter your natural resource stocks. Please, no crypto. Please, no technology. Please, no pot stocks. I'll rank them 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues if I think my comments have some value. Yeah. For those who care, if you mention charts in the question line, I will include the Barron's Gold Mining Index, which is the best pictorial lesson on the anatomy of gold bull markets and bear markets available. And I will also include a 100-year commodity chart that discusses visually how cheap commodities are relative to other asset classes going back 100 years.
I appreciate that, Rick. I think I speak for the entire audience. Thank you for all you do for the sector and you continue to do. And come back anytime, please.
How about tomorrow?
Sure, we should have a daily show, right?
I'm all over it, Daniela. But by the way, just to add some levity in this, I noticed in some of the comment section the last time that they described you and I as Beauty and the Beast. Now, it doesn't bother me too much that they refer to my great beauty, but I hate it when they describe you as a beast.
You know what? I have thick skin. It's okay, Rick. I'm used to it. I've been doing this way too long. Just don't insult my family and we're good.
It's an absolute delight to be on with you. Thank you.
Thank you, Rick. Always a pleasure having you on. And thank you all for watching. We'll have much more for you on Stansberry Investor. In the meantime, if you want premier access to content you can't find or get anywhere else, don't forget to subscribe at danielacambone.com. That's it for me. Thanks for watching.